There's been a growing trend in Web3 projects announcing that they're going to do token buybacks. The latest example being Aave, with their governance proposal that includes a token buyback of $1 million per week for the next 6 months. Token buybacks are therefore more relevant than ever and an important concept to understand. So in the next few minutes, I'll explain a little bit more about buybacks, why projects do them, how they work, and what the drawbacks can be. This is a post by one of the leaders showing that they're, about their proposal, which, as I say, includes buybacks. When the proposal went out, Aave jumped up 21% in 24 hours. There's obviously interest in it, but the whole market's been collapsing and going down, so it's corrected back, and that gain was lost. But there was interest at the moment that the governor's proposal was made, right? It's important to note, though, that the proposal included a lot of other mechanics beyond the buybacks too, which are nicely summarized in this hyperlink if you click on here, right? However, the buyback was one of the most important points discussed. Fundamentally, buybacks are exactly what the name implies. They are when a project buys back more of its own token on the secondary market, usually in a bid to spur price movement upwards. Aave is the market leader in the DeFi lending space with the largest TVL of all DeFi projects in the entire crypto space other than Lido, both of which have almost $18 billion in TVL, right? You can see here, Lido and Aave basically at 18 billion both. They're also, Aave are also doing big numbers in revenue, having made over 360 million this last year alone, and appear to feel comfortable in spending some of that revenue on buybacks. It's not just Aave though. We've seen other high revenue earning DeFi protocols like Maker, which is now called Sky, Radium, and Jupiter implementing similar buyback programs. Jupiter earlier this year at Istanbul event saying, hey, 50% Jupe buybacks. So given several projects do it, let's take a look at how buybacks actually work. Before that though, if you want to set up your first crypto wallet so that you can take part in the growing global crypto economy, plus access over $1,900 worth of courses entirely free, then click the link in the description below. Now, token buybacks usually involve a project taking some of the revenue they've generated and using it to buy up part of their own token supply from the secondary market. So they go into the secondary and buy up more of the tokens that they've created and they hold. It's essentially a signal of strength to the market, that the project is so confident in its own success that they're willing to part with their own revenue to buy up more of their own tokens. Consequently, buybacks in principle have a positive effect on both the demand and supply of a token, right? In principle, they're not alone, right? On the demand side, they literally increase demand because the project is actively buying up the token from the secondary market. So, if someone goes into the secondary market like an exchange or a decentralized exchange and buys the tokens, it pushes demand up and pushes the price up, and they're actively doing that. And this signal of strength will then generally incentivize others to buy the token too, generating further demand. Meanwhile, on the supply side, the tokens that are bought are generally taken away from the exchanges and only used further down the line, for ecosystem related things. So it generally reduces the token supply on secondary markets too. In some cases, these tokens are even burned, in which case they constrain the supply forever. So you see here, this demand graph moves up, shifts to the right, and the supply shifts back. Then you get this higher price, right? You get less supply, more demand, pushes up the price. Some may question if buybacks are a good use of projects' money. Obviously, the outcome isn't perfect to predict because it's not alone. There are other buyers and sellers in the market, but it represents the company or the project taking a risk on itself and shows strong alignment with its own success. In traditional stock markets, when companies have excess revenue and they feel confident about their continued growth, they can do something very similar called a stock buyback, which follows the same principles. It aligns incentives throughout the board as this revenue essentially gets spent to grow stock prices, effectively spreading that value over all shareholders, who can be employees, customers, investors, and company directors. Anyone who's committed to risk their own money on the success of the company, right? Shareholders are those who've risked their own money. They're not just employees or customers. They've actively gone and bought stock in the company and put their own money at risk, And the company, when it does a stock buyback, it's actively saying, look, we believe in our success too, and it kind of essentially spreads that revenue through all those shareholders who've taken a risk, right? And as I say, the shareholders can be employees, they can be customers, they can be outside investors or directors in the company. And the higher stock valuations then generally mean the companies can raise more money and continue to serve their customers, employees, and shareholders further. So it's an overall, it's very aligned with the success of the company, the customers, and everyone else, right? So it seems like a good idea, but what's the downside? Well, firstly, although a project's intentions may be good, it might just not be a very significant amount of money to make any real impact on the token price. In Aave's case, for example, they're going to do $1 million per week for the coming 6 months, which is, only for $24 million in total. And considering Aave, as of today, has a market cap of over $2.6 billion, this is just a drop in the ocean, right? $24 million isn't really going to move the needle. It's therefore a risk with, that they're taking with the project's revenue that may not be worth taking, as the market may simply have more sellers than buyers, for their token, and the project can lose out. This has been the case of Radium's token buybacks, where they experienced over $80 million unrealized loss on the, at the current price of Ray. So they bought a bunch of Ray, put this much in, bought back this, but actually it's worth less now. And so they've had this unrealized loss. Unrealized because they haven't sold yet. And if they were to sell, they would experience that loss. But if the price goes up of the token in the future, then it will be a gain, right? But it's essentially taking revenue, which is kind of risk-free money, and betting it on yourself, which is risky, right? Moreover, this revenue could instead be used in other ways to ensure a project's growth and cement it even further as the market leader. In Aave's case, for example, DeFi is still incredibly young, and although they are the market leader today, they could quite easily be disrupted by a new player and shouldn't get overconfident yet. This is a post from Blockworks where they say it's unclear the DeFi lending markets can crown a king yet. By allocating treasury reserves to buy back a token instead of reinvesting in innovation and beating the competition, Aave potentially lowers the barrier for competitors that want to, eat their lunch. Another point is that while Aave does indeed have money spare to allocate to this, many projects attempt buybacks when they aren't even earning enough revenue. And that's a recipe for disaster. If you're burning revenue needed to keep the project afloat by doing buybacks, you're essentially giving out handouts to the market. Large token holders can sell their tokens and essentially siphon out that revenue and immediately back into their hands, right? Furthermore, while many projects have wanted to do buybacks, the regulatory environment has been very hostile to crypto for some time now. In the past 4 years, the SEC under Gary Gensler went after pretty much any and every big crypto player. So most projects were fearful of doing anything that remotely mirrored traditional stocks. And that returned value to token holders, because then they would be classed as a security. The SEC ironically created an environment where it felt safer for a founder to launch a meme coin with no intrinsic value than a real profit-generating project. Thankfully, this is clearly changing under the new Trump administration, and this proposal from Aave to do buybacks is almost definitely a reaction to the new administration being more pro-crypto and signaling projects don't need to be as fearful, right? Now, the stock market has successfully grown up and to the right for as long as anyone can remember, over long enough periods of time. Sure, it drops if you have a short window, it can drop in 6 months, 12 months, but if you look over 10-year windows, 20-year windows, the S&P and similar indices have just gone up and to the right. And it's mainly because of the fundamental growth in company profits, right? More companies with more profits represent a growing economy and therefore a growing stock market. In the stock market, these profits are either reinvested in the company to grow further or returned to shareholders through dividends or stock buybacks, which we mentioned before. Web3 projects have largely been unable to do much in terms of dividends and buybacks for fear of getting deemed a security and attacked by the SEC, as I just said, right? And this has left crypto predominantly as a space that's focused on speculation. The tides are changing now, though, with the new administration. We may begin to see a change right here. Effectively, it's through giving back to the shareholders that the stock market has continued to grow on a fundamental basis. And if projects in crypto are able to use these same tools, we'll undoubtedly see the same sort of fundamental growth in crypto too, moving it away from just being a mostly speculative space, which is a good thing, right? We can only hope that Aave's token buyback move is a signal of what other Web3 projects will do more and more, and marks a shift towards a more mature market that will be supported by regulators to grow and be able to give back and drive fundamental value back to the token holders, right? And on that note, if you want to set up your first crypto wallet so that you can take part in the growing global crypto economy, plus access over $1,900 worth of courses entirely for free, then click in the link in the description below, and I'll see you there.